Welcome back to AlgoBot, the channel where we break down automated trading strategies for MetaTrader 5, one line of code at a time. I'm your host here at AlgoBot, and today we're exploring an expert advisor called Regression Slope Momentum. This strategy fits a least squares linear regression line to recent closing prices to read the direction and strength of a trend, then normalizes that reading with the average true range so it stays in tune with market volatility. By the end of this video, you'll understand how it signals its entries, how it handles its exits, and how it sizes each position. This is educational content only, so let's dig in. So what does this expert advisor actually do? At its heart, Regression Slope Momentum is a trend-following system. Instead of using a classic moving average or an oscillator, it takes the last 20 closing prices and fits a straight line through them using least squares linear regression. The slope of that line tells us how much price is changing per bar on average. A rising slope points to an uptrend, and a falling slope points to a downtrend. Here's the clever part. A raw slope in points means very little on its own, because a calm market and a fast market move at completely different scales. So the strategy divides that slope by the average true range, turning it into a reading expressed in, quote, ATR-per-bar. This normalization means the same threshold works whether the market is quiet or active, because the measurement automatically adapts as volatility expands and contracts. The strategy only acts when this normalized slope freshly crosses a set threshold, by default 0.05. That single design choice does a lot of work. It filters out low slope chop, which tends to produce whipsaws, and it fires discrete entries rather than re-triggering on every single tick. The result is intended to be fewer, cleaner signals that focus on moments when momentum genuinely shifts. Risk is handled with an ATR-based stop loss and take profit, and position size is both volatility targeted and equity scaled. So size shrinks when volatility rises and adjusts as the account balance changes. In terms of who this style suits, it leans toward traders who are comfortable with a systematic, trend momentum approach and who understand that trend systems tend to sit through quieter phases while waiting for cleaner directional moves. Remember, every strategy carries risk, and losses are a normal part of trading. Nothing here is a recommendation, only an educational walkthrough. Let's walk through the logic step by step. First, the expert advisor works on completed bars only. It checks for a new bar and ignores everything in between, so all of its decisions are made on finished candles rather than on noisy intrabar movement. On each new bar, it calculates the average true range over the ATR period, which is 14 by default. This is the volatility yardstick for everything that follows. Next, it fits a least squares linear regression line through the last 20 closing prices, controlled by the RegPeriod input, and it reads the slope of that line. The slope represents the average price change per bar. So a positive slope means the fitted line is pointing upward, and a negative slope means it is pointing downward. That slope is then divided by the current ATR to produce the normalized slope, measured in ATR-per-bar. Now comes the key condition. The strategy remembers the previous bar's normalized slope and compares it to the current one. A long signal appears when the reading was below the threshold on the prior bar and has now risen to meet or exceed it. A short signal appears when the reading was above the negative threshold before and has now fallen to meet or drop below it. Because it requires that fresh cross, the strategy signals once as momentum shifts, rather than repeating while the slope simply stays strong. Exits are handled in two ways. If a position is already open and the opposite signal appears, the expert advisor closes that position first, following an exit and reverse design. If no opposite signal appears, it simply holds and lets the protective orders do their job. Every trade is placed with a stop loss set at 2 times ATR away from entry and a take profit set at 3 times ATR, which frames a reward to risk of roughly 1.5 to 1. Finally, position sizing is dynamic. The base lot size is scaled down when current volatility runs above the locked-in baseline, and scaled by the ratio of current balance to the starting balance. Size is then clamped within a sensible band and rounded to the broker's volume step. The idea is to keep per-trade exposure steadier and to soften drawdown when markets get fast. Again, this is a description of the mechanics, not a promise of any outcome. Let's read through the actual meta-editor code on screen. At the top are the input parameters. RegPeriod is the regression window, 20 bars by default. Slope threshold is the normalized slope level the reading must cross, set at 0.05. ATR period controls the volatility measurement, and SlAtrMult and TpAtrMult are the stop-loss and take-profit multipliers, 2 and 3 times ATR. Base lots is the starting position size. Just below, the code computes the slope of the regression line, then divides it by ATR to get slope norm, our ATR-per-bar reading. The two Boolean lines define the signals. The long signal is true when the previous reading was below the threshold and the current reading has risen to meet or exceed it. The short signal is true when the previous reading was above the negative threshold and has now fallen to meet or drop below it. Now look at the buy block. When the long signal is true, the entry is taken at the ask price. The stop loss is placed 2 times ATR below entry, and the take profit 3 times ATR above it, before calling trade.buy. The sell block mirrors this exactly. When the short signal is true instead, entry is taken at the bid, the stop loss sits 2 times ATR above entry, the take profit 3 times ATR below, and trade.sell sends the order. Same structure, opposite direction. That symmetry is what lets the strategy respond to momentum in either direction. Let's bring this to life on the chart. Up top you can see the price candles with the blue regression line running through them, and in the panel below is the star of the show, the normalized slope, measured in ATR-per-bar. Watch the two dashed levels in that panel, the long threshold at positive 0.05 and the short threshold at negative 0.05. Those are the lines our reading has to cross. Look at the first 3 candles. Price is drifting sideways in a tight range, and the regression line is almost flat. Down in the panel, the slope is hovering right around 0, while inside the neutral middle ground. There is no clean trend here, so the strategy stays patient and does nothing. This is exactly the low slope chop the threshold is designed to filter out. Now watch the 4th candle. Price pushes up off the range and closes higher. The regression line begins tilting upward, and the slope reading climbs and crosses up through the positive threshold. On the previous bar it was below that line, and now it has risen above it, and that fresh cross is our long condition. You can see the buy entry marker appear right there. At that moment, the strategy places its stop loss 2 times ATR below entry and its take profit 3 times ATR above, giving that reward to risk of about 1.5 to 1. From there, momentum carries the move. The 5th, 6th, and 7th candles print higher highs and higher lows. The regression line steepens, and the slope pushes deep into the bullish momentum zone. Notice the strategy does not keep adding trades as the slope stays strong, because it already crossed once. It simply lets the position run. By the 7th candle, price reaches the take profit target, and the long trade closes for a completed move, all managed automatically by that ATR-based target. Now the character of the market changes. On the 8th candle, price stalls near the top and closes well off its high. The regression line rolls over, and the slope reading starts falling fast. By the 9th candle, price breaks lower. The slope crosses down through the negative threshold, and that fresh downward cross is our short condition. The sell entry marker appears here. This time the stop loss is placed 2 times ATR above entry and the take profit 3 times ATR below, mirroring the long setup in the opposite direction. Follow the next few candles down. The 10th and 11th candles extend the decline. The regression line points clearly lower, and the slope sits firmly inside the bearish momentum zone. On the 12th candle, price reaches the downside take profit target, and the short trade closes. Then, on the final candle, price steadies and the slope begins drifting back toward the neutral middle, where the strategy once again waits for the next genuine shift in momentum. So in one clean sequence, you have seen both sides of this system. A fresh cross up above the positive threshold opened the long, a fresh cross down below the negative threshold opened the short, and in each case, an ATR-based stop and target framed the trade. The whole point of normalizing by ATR is that these same thresholds keep their meaning whether the market is calm or fast. Of course, real markets are messier than an illustration. Signals can fail, and stops are reached regularly. This walkthrough is for education only. And that wraps up our breakdown of regression slope momentum. We covered how it fits a least squares regression line to recent closes, how it normalizes that slope by ATR into a volatility-adjusted reading, and how a fresh cross of the threshold defines each entry. We also walk through its exit and reverse logic, its ATR-based stop and target, and its volatility-targeted, equity-scaled sizing. Everything you have seen here is for educational purposes only and is not financial advice, a recommendation, or a solicitation to trade. If you found this useful, please like the video, subscribe for more MetaTrader 5 strategy analyses, and drop a comment telling us which strategy you'd like us to explore next. You can find more at www.algobot.live. Past performance does not guarantee future results. Trade responsibly.